This essay was published on Substack earlier this week, and the market responded by a massive sell-off of investors. I think the Dow Jones lost some 800 points on Monday alone, as more and more investors are getting spooked about the potential for an AI-based white-collar bloodbath that could decimate the economy this year. And I think these fears are becoming more and more well-founded as new tools are being released by AI companies that really demonstrate the agentic capabilities of AI. And I know a lot of you watching this are going to say, well, this is overhyped, this is overblown. A lot of these companies are trying to build up they're trying to build up enthusiasm for their tools, right? Because they have built business models predicated on people using these tools and paying for licensing fees. And while that is true, I think this is a very transformational technology that is going to undermine the premise of white collar knowledge work. And because so much of our economy is built around white collar knowledge workers, this is going to have a profound impact moving forward. So I think this essay touches on a nerve that shows the different compounding consequences of the AI revolution. It's not just about whether or not AI can do your job today, and it's not based on how well you yourself understand how these tools work. A lot of this is going to be built on how companies perceive AI, how they're adopting it within their business models, and the consequence that is going to have to those business models to begin with. So this is a piece written by Citrini Research. I'm not too familiar with them. It says that they focus on thematic investing and global macro trading, but this is basically a scenario. It's a letter written from the perspective of 2028 to their investors, highlighting what has transpired within the economy over the last 2 years. So from now to 2028. And the idea of this is to give a window into where we could be heading based on how AI is progressing. And it looks at this from the lens of financial investors and the financial market. And I think that's really important because a lot of the folks who've been talking about AI and issuing some warnings about AI, they're folks who are deeply embedded within the development of AI itself. So of course they're biased, right? But once you start seeing things like this emerge from people who are kind of on the periphery of AI, and then sure, they might talk about it, right? But these aren't the folks who are writing this and macro traders. They're not the ones who are sitting and writing the code, and they're not, behind the scenes at Anthropic or OpenAI developing this. They're the ones who are funneling capital into it. So they're paying attention, but they're paying attention from a very different perspective. And so what I try to do is I try to look at where things overlap. So when you have AI technologists warning about white collar layoffs, folks like Dario Amodei at Anthropic talking about how upwards of 50% of entry-level jobs could disappear within the next couple of years. When you have folks issuing those warnings, and then you have folks like this who are talking about it from a macro investing perspective, also issuing warnings, that lends some credibility to it. That I look at it like a Venn diagram. I see where there's overlap, and I see where, okay, potential, things could go south really quickly. And so from my perspective, I think it's better to anticipate the worst case scenario and prepare for that now, than continue to, just say, okay, well, this is all overblown. AI hasn't taken my job yet. This isn't happening like people are talking about. It's all hype, yada, yada, yada. I think it's better to prepare for the worst and hope for the best. And if you're prepared for the worst, then you're prepared. And if you continue to pretend like it's not happening or that we're not potentially heading in this trajectory, then you're going to be caught flat-footed for all the reasons that are laid out in this essay. So it opens up with a theoretical question, and it's what if our AI bullishness continues to be right? And what if that's actually bearish? So the argument is that what if all of this that we're experiencing right now, this growth, this boom in AI it's actually correct, it's actually happening, like things are taking off, stocks like Nvidia are just going through the roof. What if that's correct? But what if on the opposite side of that, what if as a consequence of that, the rest of the economy crumbles? So yeah, you have massive growth in a handful of AI forward companies, and they're the people who have built those companies, and the investors who are invested in those companies are going to make out like bandits. But But what if it leaves everyone else in the economy hanging high and dry? And I think there is some merit to that question. There's this assumption, and this is something that is being touted by those developing AI, is that everyone's going to reap the benefits of this, and that's absolutely not true at all. A handful of people are going to reap the benefits, and even within that handful, only a small minority of investors are really going to see the fruits of this. The vast majority of people are going to be left to hang out to dry. And so this kind of gives a window into what the future economy could look like and why this is going to be more catastrophic than people realize. So it opens it up, again, from the perspective of 2028. And so it talks about how within 2 years, transformation within the economy went from being contained to a specific sector. So I think here it's referring to tech and specifically SaaS, software as a service products, to an economy that no longer resembles the one any of us grew up in. So for the past, couple decades, we've been living in a white collar, knowledge dominated economy. Where people went to learn to code. They got these nice 6-figure jobs. They were able to buy houses. They were able to have, discretionary income and, lead high quality lives, right? So we've built an economy around that and this idea of a perpetual engine of growth that is fueled by technology. When in reality, that might have been a false premise. And so the argument here is that something that started to manifest within tech, and you're seeing it now, right? A downturn in hiring in tech, a decline in demand for software engineers. What if that proliferates to the rest of the economy? And what are the consequences of that? And so it talks about here, it says the euphoria was palpable. So by October 2026, the S&P 500 flirted with 8,000. The NASDAQ broke above 30,000. The initial wave of layoffs due to human obsolescence began in early 2026, and they did exactly what layoffs are supposed to do. Margins expanded, earnings beat, stocks rallied. Record-setting corporate profits were funneled right back into AI compute. And this is what we're seeing now, and this is why I think a lot of people think AI is overblown, is because you are seeing massive growth in the tech sector, in the AI sector of the economy. You're seeing tremendous growth, and it just doesn't make sense because you look at a company like OpenAI, for example, and they just don't have the revenue to make the math work on paper. So a lot of people are scratching their heads. You look at all the circular deals they've signed. You're like, okay, how exactly is this making sense? How are these companies generating such high returns when there's nothing there? And that's why a lot of people think we might be in an AI bubble. But in reality, what's happening is a lot of these companies are kind of rejiggering their balance sheets. They're making themselves look good so they can attract capital in ways that allow them to reinvest it back into AI computing power. And so that's why you're seeing already layoffs are underway. And part of this is, yes, some AI displacement. Part of it, too, is just replacing high-cost American workers with lower-cost international workers, predominantly in India. So you're seeing that in the H-1B visa program. But you're also seeing it in the development of campuses in India itself, where companies like Microsoft are now outsourcing operations to. And so it talks about here how real output per hour rose at rates not seen since the 1950s, driven by AI agents that don't sleep, take sick days, or require health insurance. And that, of course, is the value proposition of working with AI. It's far cheaper than working with human labor, and it's more reliable. And so the owners of compute saw their wealth explode as labor costs vanished. So what that means is over time, we've moved away from our economy being predicated on owning the means of production, so owning the means of productive capabilities and productive capacity, to owning the means of computational power, owning algorithms. So in the past, all you had to do was, own a railroad, own a factory, whatever, and that was the means to becoming hyper wealthy. Now it's owning a tech company or being a substantial investor in a tech company that has proprietary algorithmic distribution, so think like Facebook, and then of course now owning AI companies, so something like xAI, for example, or OpenAI. Those who have ownership in those companies, so whether you're an employee working at a company like that and you have equity, whether you're an investor or whether you're a founder, those are the ones who are going to see their wealth exponentially explode. The rest of us are going to be left in the dust, and that's because White collar workers are going to be losing their jobs to algorithms and machines far quicker than we can comprehend right now. And that's going to force people into lower paying roles, and they're not going to be able to maintain their current standard of living in those new roles. This has already happened. We saw this with deindustrialization in the Midwest during the 1990s and in 2000s and into the 2010s. You saw folks who were working at, say, like a GM factory manufacturing cars for $35 an hour at a union job, and that got swapped out with folks having to take minimum wage jobs, maybe making, upwards of, say, $15 an hour working at a warehouse distribution center, right? So we saw the loss of jobs, high-paying productive jobs in manufacturing, and we saw a replacement with lower quality jobs in return. So this is going to happen. This already happened to blue-collar workers. This is going to happen to white-collar workers as well. And so they talk about here how this is going to create a ghost GDP. So it's going to make it seem like the economy is growing and things are all hunky-dory, but in reality, whatever growth is happening is not circulating within the real economy. So in this case, within Main Street. And you're already seeing the consequences of this, right? I mean, you're seeing people who are trying to keep up with a rising cost of living, being paid in a debased currency with wages that have stagnated, and loss of access to credit within that economy to be able to maintain their lifestyle. So they're having to trade down, they're having to live with less. And there's some good to that, right? I think a lot of us have been living beyond our means for a while, but this is actually emblematic of a much more serious problem. This is a symptom of something that suggests that the mechanism through which wealth and productivity gains are redistributed throughout the economy, jobs, no longer exist. So that linchpin is gone. And so workers, average people on Main Street, have been decoupled from the wealth generating capacity of the economy itself. So the economy is bifurcated and it's quickly running away. And now that you have AI becoming more and more capable of doing the jobs of white collar workers, that is going to continue to negatively impact it's going to continue to negatively impact workers and their ability to maintain their quality of life. So it says here, the velocity of money flatlined, human-centric economy, 70% GDP at the time, withered. We probably could have figured this out sooner if we just asked how much money machines spend on discretionary goods. Hint, zero. So this is one of the big problems with this that people, I think, are starting to think about. And I've read some of the comments that y'all have left talking about this. It's like, well, okay, if AI takes everyone's jobs, how are we going to buy stuff? Well, I think we're going to move away from a consumer economy because it's not going to be sustainable for much longer. And that's going to be what's tremendously disruptive, because almost all of our economy is predicated on consumer spending through the use of discretionary income. So income that we don't spend on, day-to-day essentials, that we can spend on, taking vacations, going out to dinner, things like that. We have an entire economy, a service economy, built around that. So when that disappears, it's going to have tremendous downstream consequences everywhere else. And it talks here, it says white collar layoffs increase, displaced workers spent less. And so you're going to see ripple effects across the country and across the economy as those who have inhabited white-collar knowledge jobs and higher-paying jobs up until now suddenly lose their income, they run out of savings, and they can't maintain their quality of life. So now your local coffee shop is going to go out of business because people aren't going to get their daily lattes. All these fast casual restaurants charging, $15, $20 for slot bowls, they're going to go out of business because they can't keep up with waning demand and rising costs. So it's going to have cascading effects. Those people in those jobs, and they're going to be more vulnerable, right? They're only working for $15, $20 an hour. So they're going to lose jobs too. Not too dissimilar from what we saw during COVID, when things shut down immediately. The difference here is this is going to be more structural long-term. COVID was something that we bounced back from that was only temporary. This is going to be longer term. So it says here, the human intelligence displacement spiral is a natural feedback loop with no natural break. White-collar workers saw their earnings power and rationally their spending structurally impaired. Their income were the bedrock of the $13 trillion mortgage market, forcing underwriters to reassess whether prime mortgages are still good. So part of this is a result of a default cycle that left private equity backed deals it created private equity deals based on continuing revenue and the assumption that revenue would remain recurring, and this built a foundation within the economy that is no longer sustainable. So it says here the first wave of defaults due to AI disruption in mid 2027 challenge that assumption. So all of this, the elimination of white collar jobs, the decline in white collar consumer spending, the fact that much of our the financial aspect of our economy, so private equity, mortgages, whatever, are predicated on assumptions of continued spending and continued employment, all of that is going to be disrupted as a result of AI. It says this would have been manageable if the disruption remained contained to software, but it didn't. By the end of 2027, it threatened every business model predicated on intermediation. Swaths of companies built on monetizing friction for humans disintegrate. So this isn't just something that's going to be contained to folks working in Silicon Valley, folks working at SaaS companies. This is going to affect every single business model built using those SaaS companies. So that is why this is pretty significant. It says the system turned out to be one long daisy chain of correlated bets on white-collar productivity growth. The November 2027 crash only served to accelerate all the negative feedback loops already in place. The government is starting to consider proposals, but public faith in the ability of the government to stage any sort of rescue has dwindled. Policy response has always lagged economic reality, but lack of comprehensive planning is now threatening to accelerate a deflationary spiral. And so this kind of outlines the main thesis of this scenario, how, and I like the term daisy chain here because I think that's pretty accurate, how one event can lead to a cascading effect on other parts of the economy that we might not recognize. So today, we're seeing displacement start to happen as a result of AI advancement in software, in SaaS. You're starting to see reactions in the market. I mean, the Dow dropped because this essay went viral a couple weeks ago. The NASDAQ declined after the release of the latest iterations of Claude, Anthropic's Claude and OpenAI's ChatGPT. So we're starting to see a reactionary response in the stock market against SaaS companies who could be displaced by new agentic coding tools. So we're already starting to see this underway. And what this argues here is this is going to have a cascading effect across other parts of the economy that are more foundational and more structural, because so much of our economic base is built on the assumptions around the business models that these SaaS companies operate around: friction and continuous revenue generation through subscription models and licensing and all that kind of stuff. So that's what this essay dives into and talks about all the different compounding consequences of it. So how exactly did we get here? It starts off by talking about how in 2025, agentic coding tools took a jump in capability. So someone working with Claude Code or Codex can now replicate the core functionality of a mid-market SaaS product in weeks. And this is something I experimented with because this has been happening not even in the last 4 to 5 weeks, where Claude Code and Cowork were introduced. I got a Claude subscription maybe a month ago after using it and just really saw the capabilities it had. But I tested out building my own website, and I effectively custom built a website, and it walked me through the whole process to do so. That's kind of like Shopify, in all honesty. It's a variation of an e-commerce website that has the capability to sell products and accept payments. So it's no different than, say, Shopify or Squarespace. I currently have Squarespace for my personal website, and that costs like $40 a month. So I was able to do in 6 hours and for $5 a month what Squarespace currently charges me about $40 to do, right? Similar concept with Shopify. So this is what it's talking about, how these tools are replacing SaaS products. It's made it far easier to do stuff on your own without paying licensing fees to use all these different SaaS tools. And this does add up. Individually, just think about how many SaaS subscriptions you have if you use a productivity management tool, if you have a website. Just think about all the costs that add up, but then think about it at an enterprise level. A lot of these companies that use these tools, and maybe you work at a company that gives you access to something like Asana, for example, they're paying a licensing fee that's far more expensive. So they have an incentive to start building stuff in-house and reducing overhead. And so this is why these tools, Claude Code and OpenAI's ChatGPT Codex, are a big deal because they're now making it possible for average people and enterprise level businesses alike to start getting rid of all of these expensive licensing fees that they had already previously been paying. And so it says here, fiscal years mostly lined up with the calendar year. So 2026 enterprise spend had been set in Q4 2025 when agentic AI was still a buzzword. So basically, businesses were setting their budgets for the following year to pay these licensing fees before these tools came online. So the mid-year review was the first time procurement teams were making decisions with visibility into what these systems could actually do. Some watched their own internal teams spin up prototypes, replicating six-figure SaaS contracts in weeks. Six-figure SaaS contracts. And that's the thing you have to think about. It's not just one-off people here having like a Slack membership or an Asana membership. It's massive vendor contracts. And then companies have teams of people that work in compliance and vendor management that manage these contracts, right? So if you can get rid of these contracts, if you can start building stuff in-house, and it doesn't have to be perfect, right? It just has to be good enough. That's a huge cost savings. So he says that summer we spoke with a procurement manager at a Fortune 500. He was talking about, the increases in these vendor fees. And so the procurement manager told him he'd been in conversations with OpenAI about having their forward deployed engineers use AI tools to replace the vendor entirely. They renewed at a 30% discount. That was a good outcome, he said. The long tail of SaaS, like Monday.com, Zapier, and Asana, had it much worse. And so these are all tools I'm sure you have probably worked with or variations of. But this is happening. So Goldman Sachs, for example, came out and they said that for like the past 6 months, they've been working with forward deployed AI engineers, I believe with Anthropic, who've been building back office automated systems for them. And I can tell you right now, I've worked at a bank and they have a ton of vendors that they work with, and there's a ton of third parties that they rely on. So anytime you use your bank, if you're not using a major bank, if you're working with especially like a smaller regional bank, they've probably contracted out their entire digital banking infrastructure to a third party. And so all that has to be managed. There's contracts that have to be approved and signed, licensing fees, all that kind of stuff that add costs. You're not just paying for the employee to sit at their, at a desk, their butt in a chair for 40 hours a week. You're also paying for all the tools they use to do their job. And so AI and the ability to create those tools in-house is going to make it far cheaper for companies to execute their day-to-day operations. So it says, SaaS wasn't dead. There was still a cost-benefit analysis to running and supporting in-house builds, and that's absolutely true. Like, there are reasons why companies haven't gone this route yet, and there's a little bit of conservatism because people aren't sure how exactly to use AI or what exactly they would replace, or they want to see a lot of folks who are waiting to see if the vendors they already work with develop their own in-app or in-platform AI tool. So rather than ditching, a vendor you've been working with for, several years entirely, they're waiting for them to come out with an AI tool. Regardless, they're all looking towards AI. So the fact that in-house is an option has factored into price negotiations. Perhaps more importantly, the competitive landscape has changed. AI had made it easier to develop and ship new features, so differentiation collapsed. Incumbents were in a race to the bottom on pricing, a knife fight with both each other, and with a new crop of upstart challengers that popped up. So this is the problem: is once you have the capability to start developing your own in-house tools that replace expensive vendor contracts, it's going to be a race to the bottom. Why would anyone pay for something when they could create it themselves? Like, I think about this with Squarespace, and I'm thinking about it right now. I've already built one website. Okay, like, maybe I should move my, personal profile, my personal portfolio website and just build that, with Claude as well. And of course, like, it's not perfect. I understand if something goes wrong, I'll have to work with someone to figure it out. But over time, like, the cost savings is huge there. And so one of the reasons why this is problematic is because SaaS companies sell seats. They don't just sell monthly membership, they sell seats. And just look at any SaaS product you use, just go to their billing page or like their options page to see which like levels you can pay for. And once you get to the enterprise level, the billing changes. So instead of paying per month or based on usage, you pay based on how many seats you need. And this is something with Notion. I use Notion, and this has been a problem for me, is anytime you share or invite someone to join your Notion, it counts it as a seat. And so you're paying a licensing fee per seat, not per account. So when Fortune 500 clients cut 15% of their workforce, they're canceling 15% of their licenses. So they're not just cutting jobs, they're cutting revenue through licenses that these SaaS companies would be generating. The same AI-driven headcount reduction that were boosting margins at their customers were mechanically destroying their own revenue base. And so this is undermining the entire SaaS tech sector, which is the majority of the tech sector right now, to be honest. Unless you're a minority company like Microsoft, Amazon, or Meta, or Google building out AI infrastructure, the vast majority of tech companies are SaaS companies, or they're AI wrapper companies. They're built on top of OpenAI, they're built on top of Anthropic. They don't actually own anything that they're doing. So at any point in time, OpenAI, Anthropic, whatever, they can just copy the features that these companies are developing, or acquire them if they wanted to, and ship them out within their portfolio of tools themselves. So this is hugely problematic for anyone who's in the tech sector. And so it says, with stocks down 40 to 60% and boards demanding answers, the AI threatened companies did the only thing they could: cut headcount, redeploy the savings into AI tools, use those tools to maintain output with lower costs. Every dollar saved on headcount flowed into AI capability that made the next round of job cuts possible. The same logic that justified ServiceNow, which I think is just a stand-in, like, hypothetical SaaS company that the author is using here. But the same logic that justified them cutting headcount applied to every company with a white-collar cost structure. So the point here is that it's not just that AI is taking jobs. AI is undermining the very premise of the business models that those jobs were built around. So suddenly, everything related to that, every service related to maintaining those jobs suddenly goes out the window. If you're not hiring as many people, you don't need as many licenses. Okay, that fundamentally undermines SaaS companies, yes, but also changes things like commercial real estate, for example. And we saw this after COVID. If you need fewer people in office to do their jobs, well, suddenly you need smaller offices, right? So that's, a big deal. Or, okay, maybe it local infrastructure, like, say, internet, right? If you have fewer people working in an office and you're not providing the tools that they need to do their job, including, say, laptops or internet access, okay, now you need a smaller internet package from your local internet service provider, right? So there are, like they said, there's a daisy chain. There's downstream consequences to this that folks aren't thinking about, and this is why the disruption is going to be massively catastrophic. And so the next section is when friction went to zero. So this is now diving into commerce. So the first section was about SaaS companies at the enterprise level. This section is about commerce and how AI agents are being deployed within commerce. So that's customer service to purchasing things, whatever. But AI assistants, once AI agents really begin to mature, it's going to lead to a proliferation of AI assistants who can negotiate on behalf of consumers. And so it says the part that should have unsettled investors more is that was that these agents didn't wait to be asked. They ran in the background according to the user's preferences. Commerce stopped being a series of discrete human decisions and became a continuous optimization process, running 24/7 on behalf of every connected consumer. By March 2027, the median individual in the United States was consuming 400,000 tokens per day, 10 times since the end of 2026. So kind of, what does this mean? So think about it from marketing and advertising, okay? Right now, you have all these copywriters on LinkedIn, and I see them because I'm connected with a lot of writers who are like, well, hey, I can't do my job. I can't write. It can't, be human. It can't do this. It can't do this. Okay, fine. Like, you can make that argument. But AI and the ability to optimize decision-making means that you don't need marketing to begin with. You don't need clever copywriting anymore because the AI agent isn't programmed to be receptive to clever copywriting. That's a human response. You're trying to convey an emotional reaction from a human consumer. If the human is no longer behind the driver's seat of their consumptive habits, if they have empowered an AI agent to make purchasing decisions for them, that AI agent is going to run in the background with a series of basically algorithmic rules telling them how to spend their person's money. So let's say you set up a grocery list, for example, and this is something I've been tinkering with, like how to optimize grocery shopping, right? So let's say you set up, you have a meal plan and a grocery list, you have everything all kind of set up online. I use Notion for my meal plan, so let's say you use Notion, and then let's say you run an AI agent through Instacart and you have it go grocery shopping for you. So all you have to do is show up, maybe to pick up your groceries, or if you use Instacart, they just come to you. So you have an AI agent that's working with you to optimize your meal plan, that's optimizing your grocery habits, that's doing everything that that you would typically do to feed your family. It's doing that in the background. It's trying to get the best price at the lowest cost, making sure that you don't misuse food, that you're nothing goes to waste, that kind of thing. It's doing all of that, and you never have to set foot into a grocery store again. Maybe use Instacart, maybe you shop with Walmart. They're growing their e-commerce footprint as well. So maybe you're doing that, and so your groceries just show up to you, say, every Friday, and you let the AI agent do it for you. The AI agent doesn't care about the copy on a box of macaroni and cheese. It doesn't care about the packaging design. It doesn't care about any of that, right? So even if those designers, the people doing that design work, think that they are impervious to displacement from AI, that AI can't possibly replace them, the fact that those designs no longer appeal to consumers because consumers are no longer at the driver's seat making purchasing decisions is what is fundamentally changing here. So they no longer have, you don't need to hire people to make clever packaging because the packaging no longer matters. If people aren't going to grocery stores anymore because they don't have to, you don't need to have eye-popping designs. You don't need to have any of that. So suddenly every single copywriter and designer who worked in that niche, they're done, right? They don't have demand for their services anymore. So that's what they're getting at here is commerce is going to fundamentally change because of that. So it gives some examples here. So agents removed friction. So subscriptions and memberships, for example, they passively renewed despite months of disuse. Introductory pricing that sneakily doubled after the trial period. I'm sure you've all experienced this. Each one was rebranded as a hostage situation that agents could negotiate. The average customer lifetime value, the metric the entire subscription economy was built on, distinctly declined. Consumer agents began to change how nearly all consumer transactions work. So basically, you could deploy an AI agent to optimize your finances for you. So instead of you having to keep an audit and a trail of how many subscriptions you're paying for and how much you're spending every month, like a gym membership, for example. A lot of gym memberships make money based on the fact that no one actually goes to the gym. Now that's going to change because an AI agent's gonna be like, well, you've only used, gone to Planet Fitness for 3 days this month. Let's cancel this membership. And then you're going to empower it to do the cancellation for you. But it's more than that. So things like price matching across different platforms. Machines are going to be able to do that. Travel booking. So it's going to be able to assemble an itinerary with hotels and flights, ground transport, faster and cheaper than any platform. And it's going to be able to take things like your credit card rewards into account. So if you have credit card rewards or loyalty points, like you no longer have to manage all of that. The AI agent will be able to take all of that information, work within a website like booking.com or Kayak or whatever, and make reservations on your behalf, and it's going to be able to negotiate. And again, you don't need fancy copy on your website for that, right? You have computers working with one another to make this decision, not a human that is swayed easily by emotions. So all those copy and design decisions suddenly go out the window. Things like insurance renewals. The entire renewal model depended on policy holder inertia, and that's going to go away. So every 6 months, your car insurance might go up, and you're prompted to shop around because that's how it works. That's going to go away. Things like financial advice, tax prep, routine legal work. Any category where the service provider's value proposition was ultimately, I will navigate complexity that you find tedious, was disrupted, as agents found nothing tedious, right? And so all of that is going to fundamentally change. Even things like QuickBooks. Like QuickBooks is what a lot of people use for, businesses will use for software, their accounting. I use it, and they've already started deploying AI within the software. But it's like, I only use a fraction of the tools in there. It's like, why am I paying $80 a month for a license to use QuickBooks, right? Like, is there a better way I could start doing this? Probably. And so I think a lot of people are starting to think like that, not just at the individual level, but also at the enterprise level. So even places we thought insulated by the value of human relationships have proved fragile. So this is a big one. Real estate, where buyers had tolerated 5 to 6% commissions for decades because of information asymmetry between agent and consumer, crumbled once AI agents equipped with the MLS access and decades of transaction data could replicate the knowledge base instantly. How many people do you know are real estate agents? Like, a lot of real estate agents don't actually sell any real estate. But for some people, like, that's their main gig. And the only reason why real estate agents matter is because they have access to proprietary housing market data that you and I don't have access to. So what happens when you suddenly don't need a real estate agent anymore, that Zillow deploys its own AI agent that can walk you through buying a house? And then what happens when that AI agent connects with a bank, say like Rocket Mortgage, for example, or some other financial institution, and it can pre-approve you and walk you through getting a mortgage? Suddenly, all of those layers of paperwork and the people that you have to work with to buy a house, gone. There's far less friction than there used to be. And so this is what the author is getting at here. It's going to be disruptive to business models, and that's going to have downstream, secondary, and tertiary order of consequences for other people in the economy that we're not actually thinking about right now. So that when you start taking the jobs of software engineers out in Silicon Valley, this is where that leads, right? It's going to inevitably lead to the loss of jobs with real estate agents, or the loss of tax professionals and things like that. And so it says we had overestimated the value of human relationships. Turns out that a lot of what people called relationship were simply friction with a friendly face. So even the thing that we think we're supposed to have like a competitive advantage at, and that is like institutional knowledge and human relationships, that might not actually matter anymore either, because once you get rid of the friction piece, suddenly you don't need it. Like, you don't need someone to translate the tax code for you if you can work with Claude or OpenAI or Gemini to translate it on your behalf, right? So you don't need an accountant necessarily, and there's already an accounting shortage in the country. So it's like, okay, well, what's the point, right? And so it says successful companies have spent billions of dollars to effectively exploit quirks of consumer behavior and human psychology that don't matter anymore. And this destroyed a particular kind of moat, habitual intermediation. And talks about here, DoorDash, for example, being disrupted because now anyone can basically vibe code their own competitor to DoorDash. And so it can allow gig workers to become more competitive on the platform and make more money by multi-apping. But allows, for example, a business, if you are a mom and pop business and you work with a platform like DoorDash or Uber Eats, a significant portion of your revenue has to go to platform fees. And a lot of these are parasitic companies. Like DoorDash doesn't really offer any value. It just takes, it's a rent collecting algorithmic company, right? And so it says here, agents accelerated both sides of the destruction. It enabled the competitors and then used them. The DoorDash moat was literally, you're hungry, you're lazy, this is the app on your home screen. An agent doesn't have a home screen. It checks DoorDash, Uber Eats, the restaurant's own site, and 20 new vibe-coded alternatives, so it can pick the lowest fee and fastest delivery every time. And so that's what's going to happen, is instead of like you and I swiping mindlessly on our phones, we're going to get to a point where we're empowering that we're empowering these agents, these AI agents, to basically be a virtual assistant. So you say, hey, I'm hungry for Thai food, and it's going to find the best Thai food wherever you live, and it's going to have the best price, and it's going to have, the quickest delivery time possible. So it's going to optimize for outcomes, which is what consumers want. But in the process, it's going to degrade all of the intermediary service providers that have been built to service those human needs and those human desires. And so it says this was oddly poetic, as perhaps the only example in this entire saga of agents doing a favor for the soon-to-be displaced white-collar workers. When they ended up as delivery drivers, at least half their earnings weren't going to Uber and DoorDash. Of course, this favor from technology didn't last for long as autonomous vehicles proliferated, and this is a huge issue. And I think a lot of white-collar workers, kind of what this alludes to, are going to be banking on doing gig work. They're going to be banking on being Uber drivers and DoorDash drivers and Instacart shoppers when they lose their jobs, because at the same time this is happening, other jobs are disappearing within the economy. So just, part-time employment that you used to be able to get, a year or two ago is gone. There's already, I saw a video on X of a robot delivering food at a restaurant in Kansas. So places are already piloting getting rid of wait staff, right? So this is happening. So you're going to lose part-time jobs. So a lot of these white-collar workers they're not going to have anywhere else to go within the economy. They're going to have to rely on Uber and DoorDash and those kinds of gig jobs. But because of autonomous vehicles proliferating at the same time, and that being a related technology that's growing alongside artificial intelligence, it's going to displace those workers too. And you already have Waymo that's piloting, I think with DoorDash in Phoenix are already piloting this, right? So it's only a matter of time before a robot delivers your food or an autonomous vehicle delivers your food, and the human drivers cut out entirely. So there was only so much price matching and aggregating to do. The biggest way to repeatedly save their user money, especially when agents started transacting among themselves, was to eliminate fees. In machine-to-machine commerce, the 2 to 3% card interchange rate became an obvious target. Agents went looking for faster and cheaper options than cards. Most settled on using stablecoins via Solana or Ethereum L2s, where settlement was near instant and the transaction cost was measured in a fraction of a penny. And this is why I have been incredibly bullish on crypto. And I think a lot of people are looking at crypto and they think it's a scam and they think it's fake. And I think like the early crypto was a wild, wild west for sure. But now that AI is proliferating and we're building an entirely new economy on top of AI and agentic commerce, like this outlines, it's going to require an entirely new type of money. The money system we have now makes absolutely no sense for a digitally native economy. So what makes sense is going to be instantaneous reconciliation and payment settlements through crypto, because crypto has made that possible. So you're going to see greater adoption of crypto. Big banks have already started developing their own in-house blockchains with their own cryptocurrencies. JP Morgan is one example. So this is inevitable, right? We're going to move towards stable coins, other crypto, CBDCs potentially. But this is huge, right? Because companies like MasterCard and Visa basically have a monopoly on collecting 2 to 3% processing fees. And, companies like Stripe, I use Stripe. A lot of people who do stuff online, they use Stripe, right, to process payments. That could disappear. So you have an entire economy within the commerce sector of the economy built on payment processing. It's like a meta economy built on payment processing. And that could disappear as agents replace consumers as the drivers of commercial transactions, and they no longer require payment in the way that humans do. They develop their own payment mechanism that cuts out all of these intermediaries to begin with. And so this is going to be huge. Agentic commerce routing around interchange posed a far greater risk to card-focused banks and monoline issuers who collected the majority of that 2 to 3% fee and had built entire business segments around rewards programs funded by the merchant subsidy. So, yeah, your AI agent is going to be able to use your credit card rewards to book travel for you, but then also those credit card rewards might disappear because the entire value proposition in which those credit card rewards were built on is going to go away as well. So like I said, massively disruptive. So it gives the example of American Express here. That's going to be hit the hardest. A combined headwind from white collar workforce reductions, gutting its customer base and agents routing around interchange, gutting its revenue model. And it calls out American Express here because if you've ever worked in a business where you've had to go on business travel, a lot of companies use American Express. You'll get an American Express card to do your business transactions. And so if you have fewer workers who are taking fewer business trips, you're going to need fewer American Express cards, so they're not going to get the spending there. But then when you take away these interchange fees, they're not going to get the revenue that they need either. So these credit card companies are going to be in for a world of hurt. And so their moats were made of friction. So companies like DoorDash, companies like American Express, they were able to protect themselves and maintain their market advantage based on friction. Now friction is going to zero. So the first part of this essay, I talked about SaaS and how the decline of licensing and seats within companies as they reduce overhead is going to translate into a reduction in annual recurring revenue for SaaS companies. But now it goes a step further. It talks about commerce and how it's going to disrupt commerce and how all of these intermediaries, whether it's payment processing or whether it's a human helping you navigate some sort of complex web of rules or something that requires some degree of expertise, how that is going to be replaced by AI agents who can work on your behalf, and how they're not going to be swayed by human psychology or emotions the way you and I are. So that's going to obviously have an effect on marketing and advertising and entire segments of the economy built on trying to convince you and I to buy things and buy as much as possible. So all of that is going to be disrupted. And so it says from sector risk to systemic risk. So those are examples of sectors within the economy are that are going to be exposed to AI in ways we probably hadn't been thinking about. Now this is going to dive into the entire system being at risk. So on January 2027, our January 2027 macro memo argued that this was the wrong mental model. The U.S. economy is a white-collar services economy. White-collar workers represent 50% of employment and drove roughly 75% of discretionary consumer spending. The businesses and jobs that AI was chewing up were not tangential to the U.S. economy. They were the U.S. economy. And so the thing that people aren't really considering is that much of the consumer spending that is happening within the economy isn't happening from the bottom. It's not happening from people on fixed incomes. It's not happening from people shopping at Dollar General. It's not happening from, retirees. It's not happening from people who are, working blue collar jobs who are already displaced by deindustrialization. The people driving the economy over much of the last 2 decades has been white collar professionals, a lot of whom are in tech, yes, but white-collar knowledge workers, the people who are living in big cities, buying homes, paying $15 for sweet green salads, it's these folks, right? And so when they lose their jobs, they lose their discretionary spending capabilities. They're not going to be able to go buy those salads anymore. So that's going to affect companies like Sweetgreen and Sweetgreen's ability to employ people, right? So there's a ton of downstream consequences to this. And so, it talks about, technology destroys jobs, yes, but it will create new jobs. And that might not necessarily be the case. So it talks about how ATMs made branches cheaper to operate, so banks opened more of them. Teller employment rose. The internet disrupted travel agencies, Yellow Pages, brick and mortar retail, but it invented entirely new industries in their place that conjured up new jobs. And so yeah, that is absolutely true. Every new job, however, required a human to perform it. So yeah, ATMs, automated banking, but you still had to have humans at those banks, like making sure everything functioned. AI is now a general intelligence that improves at the very tasks humans would redeploy to. Displaced coders cannot simply move to AI management because AI is already capable of that. So whereas blue-collar guys who were displaced due to deindustrialization were told to go learn to code, and they did. Now they've learned to code, okay, but there's nowhere for them to retrain or reskill to except to go, maybe to another blue-collar trade. There's nowhere to go from here. There's nowhere for workers to move unless you move out of the white-collar sector of the economy entirely. So that's what's going to be hugely problematic. So yes, AI has created new jobs. Prompt engineers, safety researchers, infrastructure technicians, and humans are still in the loop, and they're coordinating at the highest levels or directing for taste. But for every new role AI created, it rendered dozens obsolete. The new roles paid a fraction of what the old ones did. So yes, AI is creating new jobs. It's creating far less jobs, and it's creating jobs that pay far less, as was too. I'm reading a book right now that talks about this, but how a lot of the work that's being done to create alignment within these AI models, that is being outsourced to contractors, a lot of them in places in, like, say, like Nigeria or in India, and these companies are paying a fraction of the price. So maybe you've seen one of these jobs come up on Indeed or LinkedIn, but it's a job where you're basically training AI, but you're maybe paid $15-20 an hour, right? So yeah, you're working with this new technology, and this new technology is supposed to be great, but you're not being paid any more than your local barista, right? So you can't really chalk that up to a win in the labor market, right? If these jobs aren't necessarily paying more or improving your standard of living, they're not going to be better. So it says white collar openings were collapsing while blue collar openings remained relatively stable. So things like construction, healthcare, trades. The churn was in the jobs that write memos, approve budgets, keep the middle layers of the economy lubricated. Real wage growth in both cohorts, however, have been negative for the majority of the year and kept declining. One thing this doesn't note is that when those white collar workers lose their jobs, they lose their spending capability. That's going to affect those blue collar jobs as well. So you might forego maintenance on your vehicle, right? If you don't have a job and you can't afford it, you might not go to the dentist, for example. And so the dental hygienists aren't going to have as much work to do. You might forego a renovation on your house or maybe purchasing a second home because you've lost your job. And so, yeah, while trades aren't going to be directly impacted by AI, they're going to be impacted by the loss of white collar spending. And so again, a secondary and tertiary order consequence here, but important to keep in mind. So the thing is, AI is getting better and cheaper over time. Companies laid off workers. They use the savings to buy more AI capability, which let them lay off more workers. Displaced workers spent less. Companies that sell things to consumers sold fewer of them. Weakened and invested more in AI to protect margins. AI got better and cheaper. So basically, this is a parasitic feedback relationship between us and AI. So as we lose jobs and we human workers lose our spending capabilities, companies are going to be pressed to invest more and more into AI in order to recover productivity gains and earnings or perceived earnings on paper. So they're going to be pushed to manipulate their balance sheets and their financials to placate investors. But they're going to continue doing so at the expense of the human worker. And so it's really ironic how this is going to work out. But it's going to lead to a deflationary spiral on the consumer side of things within the economy as we know it, even though at the same time it might create what could appear to be growth on the paper side of things. And so that's why they open this up talking about how things seem bullish now but could actually be bearish, because on paper things are going to be looking great, right? They're going to be appealing to investors because that's the target demographic of companies. It's not consumers, it's investors. And so things are going to look great on paper, but in practice, that's where things are going to really decline and deteriorate very quickly. So it says AI investment increased by multiples, but it occurred as a reduction in total operating costs. Every company's AI budget grew while its overall spending shrank. So they're going to spend, and then you're seeing this with Amazon, right? People are like, well, they just cut thousands of jobs. How are they increasing their capital expenditures, for AI investment so rapidly this year? And this is exactly it. It's because by cutting operating costs, they're able to redeploy that capital into AI and investment, and those AI things that they're investing in, and that's going to lead to productivity gains. So whatever they lost from the workers that they displaced, that they got rid of, they're going to eventually capture back with AI development. And so one thing that this notes to that I think is important is that this isn't just going to be contained within the United States. This is going to have a global impact. So it talks about India, for example. The country's IT services sector exported over $200 billion annually, the single largest contributor to India's current account surplus and the offset that finances persistent goods trade deficit. The entire model was built on the one value proposition: Indian developers cost a fraction of the cost of their American counterparts. And so as much as we hem and haw right now at the H-1B visa program and companies like Microsoft offshoring American jobs to India, this is going to have a devastating impact on the Indian economy as well once this really starts to play out, because eventually those jobs are going to go away too. So while India has built its own knowledge sector around IT services and exporting those services to American companies, eventually American companies aren't going to require that anymore. So they're going to lose their jobs too. But these other companies, these other countries don't have the capacity to absorb job losses in the same way that maybe the United States might be able to. Places like, you're seeing this in places like Indonesia, for example. They had protests last year, almost as a direct result to Trump's tariffs and waning demand for textiles and apparel coming from Southeast Asia. Indonesia is a major exporter, and it works with a lot of distributors in China, for example. So when the Trump tariffs went into effect, it changed global supply chains. And so that had an impact on people working in textile manufacturing in Southeast Asia, because suddenly demand for cheap manufactured goods from Asia declined due to rising costs invoked by tariffs. So that led to protests in places like Indonesia, because suddenly you had workers who were without work. So this isn't going to be contained just to the United States. This is going to have tremendous consequences. And yeah, so just because, a worker in a place like China or Southeast Asia isn't going to be displaced by AI directly, it's going to have a massive consequence. The Philippines is a great example. A lot of virtual assistants are based in the Philippines. A lot of companies have outsourced already, back office and administrative work to virtual assistants. So what happens when you replace those virtual assistants with AI agents? Well, the entire economy, the Filipino economy is going to collapse, right? So you're going to have countries that are going to suffer the consequences of this too. It says the engine that caused the disruption got better every quarter, which meant the disruption accelerated every quarter. There was no natural floor to the labor market. In the US, we weren't asking about how the bubble would burst in AI infrastructure anymore. We were asking what happens to a consumer credit economy when consumers are being replaced by machines. And so this is what this is starting to get at, as well as how the economic engine underpinning all of this and then the structure of our economy is going to face a reckoning because of all of this. So it says displaced white collar workers did not sit idle. They downshifted. Many took lower paying private sector and gig economy jobs, which increased labor supply in those segments and compressed wages there too. And again, you're already seeing this. This is already happening. A friend sent me a posting. Someone was looking for a job for an event for a weekend that I might have been interested in. So I reached out and said, hey, what are you looking for? What availability do you need? They got back to me. They told me, and they said the starting pay was $10 an hour. $10 an hour. I don't know a single person who would voluntarily work for $10 an hour in 2026. But that's where it's at, right? Because there's so many people who are desperate for work that they're willing to take whatever they can get. And unfortunately too, and this is where the immigration and illegal migration piece of this comes into play, is now you have a large cohort of workers in the United States who are working illegally under the table, but they're working against a different standard of living than American workers. So while a tech worker who has lost their job might be willing to take, a $25 an hour job, begrudgingly, but they might be willing to take it because at least it'll help them keep a roof over their head. Have competition with illegal migrants, for example, working in gig economy jobs. They're subleasing someone's account, right? But they're going to be willing to work for $10 an hour, because even for them, $10 an hour is still far better than what they were earning in their home country. And they still have enough to send back home to help family that are still there. So you're going to see this as well. So it's not even just, white collar workers competing with gig workers and part-time workers in retail and hospitality. You're going to see everyone competing with illegitimate workers who shouldn't even be here in the first place, people who have come here for economic opportunity that simply does not exist. So that's going to create a huge problem socially within the country. It says, gives one example here, how a friend, again, this is hypothetical, but a friend who was a product manager at Salesforce was laid off, lost their $108,000 a year salary. After 6 months of searching, this person started driving for Uber. Her earnings dropped to $45,000. But again, this isn't going to be guaranteed because Uber is going to be automated out. Uber's already partnering with Waymo. It's only a matter of time before autonomous vehicles replace Uber drivers as well. Multiply this dynamic by a few 100,000 workers across every major metro area. Overqualified labor flooding the service and gig economy pushed down wages for existing workers who were already struggling. Sector-specific disruption metastasized into economy-wide wage compression. Then, of course, There will always be those employers who want to cut costs even further because costs are going up for them as well. And so again, this is why paying attention to the illegitimate or illegal migration aspect of the labor market is important too, because those are workers who are going to be highly susceptible to exploitation by employers to work for lower wages, but they're also going to compete with American workers as well for a dwindling pool of jobs. So the pool of remaining human-centric, I think work had another correction ahead of it happening while we write this, and autonomous delivery and self-driving vehicles work their way through the gig economy that absorbed the first wave of displaced workers. So like I said, it's only a matter of time until those autonomous vehicles become mature and displace workers as well. It says, in this cycle, the job losses have been concentrated in the upper deciles of the income distribution. They are a relatively small share of total employment, but they drive a widely disproportionate share of consumer spending. The top 10% of earners account for more than 50% of all consumer spending in the United States. The top 20% account for nearly 65%. These are the people who buy the houses, the cars, the vacations, the restaurant meals, the private school tuition, and home and renovations. They are the demand base for the entire consumer discretionary economy. So basically, your top earners, as much as your socialist Gen Zers, the ones who voted for Zoran Mamdani, complain about the wealthy. That's the hand that feeds them, right? So yeah, like you might not like that there's wealthy people, but those wealthy people are the ones who go and spend money, right? And so they're the ones who are tipping you they're going to the restaurants first and foremost, and they're the ones who are tipping you. Your peers aren't, right? You're not earning an income because your friends are all going out and tipping you when they go out. It's because there's people who have money that are going. So maybe it's wealthy business owners or real estate folks. Maybe it's people who were born with a silver spoon in their mouth. Maybe it's baby boomers who are sitting on their nest egg. For whatever reason, there are people who have money, and those are the ones who are spending, and they are the ones who are distributing their money throughout the rest of the economy. You used to have that coming from white-collar knowledge workers earning high incomes, but as those jobs go away, that part of the consumer economy is going to disappear as well. And frankly, those who have assets, those who work with financial managers, they're not going to be the ones who frivolously spend money to begin with. So paying attention where the flow of money comes from is important. It comes from employers, but it also comes from high income earners as well. And so if employers stop employing and high income earners lose their jobs and stop spending, it's going to trickle down to the rest of the economy. It says when these workers lost their jobs, they took 50% pay cuts to move into available roles. The consumption hit was enormous relative to the number of jobs lost. A 2% decline in white-collar employment translated to something like a 3 to 4% hit to discretionary consumer spending. Unlike blue-collar job losses, which tend to hit immediately, you get laid off from the factory, stop spending next week. White-collar job losses have lagged, but a deeper impact because these workers have savings buffers that allow them to maintain spending for a few months before the behavioral shift kicks in. I would argue, too, credit cards. Credit cards are the safety net of the upper middle class, right? And so as credit card debt continues to bloom and as people get maxed out, it's going to force behavioral changes. You're just not going to have the money. Like you don't have the income. You don't have the room on your credit card. Like you're not going to go to the nail salon anymore. You're not going to get the dry cleaning. You're not going to shop at Whole Foods. So this is going to lead to a change within how people behave. And you're already seeing it. People have downshifted from shopping at Target, for example, to shopping at Walmart. And so that's an example of a consumer base who might rely on savings or credit cards to continue spending at Target and continue maintaining a facade of like a well-to-do middle-class life. They're now shifting to shopping at Walmart, the same as people on Snap, right? So you're already seeing this where people shop, and I think this is only going to continue to pick up speed. And so this next section dives into what they call a daisy chain of correlated bets, but how this maps onto the financial aspect of the economy. So it gave sector-specific examples, the consequences there. It talks about how this is going to trickle down into consumer spending and how it's going to have a structural impact within the economy. But now we have to talk about the financial side of it because this is really what underpins a lot of this and the flow of capital in particular. So it talks about here, they give a bunch of hypothetical headlines throughout this essay, but it talks about how Moody's downgrades $18 billion of pre-backed software debt. It says software-backed loans began defaulting in Q3 2027. PE, so private equity portfolio companies, and information services and consulting followed. So what this is getting at is something that I don't know anything about. So if you do, please chime in the comments. But kind of in much the same way that there's a lot of shady stuff happening with mortgage-backed securities and credit default swaps in 2008 that led to the financial crisis. There's all sorts of derivatives markets within the financial industry. People are packaging different types of debt, they're selling them, and investors are buying them. So you have people who are buying mortgages, yes, people who are buying commercial real estate, people who are buying private equity, people buying consumer credit card debt. So all sorts of debt is basically bought and sold in derivative markets, and it's packaged and kind of, if you've watched The Big Short, this will make sense, but they'll package it with good debt and bad debt so you can mitigate some of your risks. But the problem that this gets at is that a lot of this debt is going to be was made based on assumptions about continued growth in the economy or the continuation of certain business models or access to consumer credit that is no longer sustainable, right? So basically the rules of operation for how our financial system is currently structured are about to go out the window as AI destroys jobs, destroys business models, and destroys the value proposition upon which the knowledge, white-collar sector of the economy was built on. So it gives the example of Zendesk here. I don't know if this is legit. If this is, someone please comment. But apparently Zendesk, it says, had a debt package of $5 billion in direct lending, backed by Blackstone, Apollo, Blue Owl, and HPS. But it ended up collapsing because it wasn't able to maintain its business model. So that's because AI agents had been handling consumer service autonomously for the better part of a year. So Zendesk offers ticketing, routing, managing human support interactions. That was being replaced by systems that resolved issues without generating a ticket at all. So the ARR, the annualized recurring revenue the loan was underwritten against, was no longer recurring. It was just revenue that hadn't left yet. So the largest ARR-backed loan in history became the largest private credit software default in history. So basically what this is getting at is within the financialization of the economy, there's underwriting to mitigate risk. And a lot of that underwriting is predicated on you and I staying employed, or businesses that have debt like this continuing to generate revenue through subscriptions and licenses. But when those SaaS companies start being replaced by in-house builds that make them obsolete, this debt becomes toxic. And so depending on, and again, I don't know enough about, Blackstone and Apollo and all these private equity, investment firms, but depending on how concentrated they are into debt, this could have the same consequence as the 2008 financial crisis. If they are overexposed, kind of like Lehman Brothers was, if they're overexposed to too much toxic debt, so maybe too much toxic private equity debt, like this could lead to a systemic collapse. Again, like we saw in 2008. And so it says executives at Blackstone, KKR, Apollo cited software exposure of 7 to 13% of assets, which they say is containable. Every sell-side note and FinTwit credit account said the same thing. Private credit has permanent capital. They could absorb losses that would otherwise blow up a leveraged bank. And again, this is why I think 2008 is a good example, because the same people that bought like the credit default swaps and stuff, there was insurance guarantees. So that's why when Lehman Brothers collapsed, AIG also faced heavy losses because it couldn't cover what was happening. And again, watch The Big Short. That explains what happened far better than I could ever explain. But I think the way I'm reading this is kind of a similar concept where you have private equity firms that have invested in debt assets and they've underwritten those debt assets with permanent capital. So it seems safe and it's very complex. So you and I don't really understand it. But in reality, what they've done is they've increased exposure across the economy. So if as this suggests that AI expansion, deterioration of the economy cannot be contained, it will have catastrophic consequences for everyone. So it says, over the prior decade, the large alternative asset managers had acquired life insurance companies and turned them into funding vehicles. So they basically used life insurance as a way to access capital to make investments. And so this is what they talk about when they say permanent capital. So this was supposed to make the system resilient. It was not some abstract pool of patient institutional money and sophisticated investors taking sophisticated risk. It was the savings of American households. Main Street, structured as annuities, invest in the same PE-backed software and technology paper that was now defaulting. And think about this. The Trump administration wants you and I to start investing our 401ks in private equity. So this is already underway, like this transformation. And it's being marketed as you and I would have the same access to investment opportunities as BlackRock, when in reality, it's exposing you and I to risk that we're not fully aware of. And so it talks about it here, and it gives some examples about how this is done. I'm not going to dive too deep into this because I think this is a little complex, but definitely go, if you're interested in this stuff, go read this section of the essay, because I think it's interesting. But it talks about the spider web of different firms linked to different balance sheets was stunning in its opacity. When the underlying loans defaulted, the real question of who actually bore the risk or the loss was genuinely unanswerable in real time. So it talks about like offshoring risk, basically, but using life insurance companies to offer, to fund the credit that asset managers are using, and then relying on reinsurers to basically kind of like launder. It seems like laundering all these transactions. But it seems this reads to me like the same sketchy stuff that they did in 2008 with credit default swaps. So so this says here, it was never the loss themselves that caused the crisis, it's recognizing them. So it's and again, this is why I think The Big Short is a good example, because it wasn't so much that everyone had started defaulting on their mortgages en masse. It was in a few markets, yes, and it was starting to grow, and it was becoming bigger and metastasizing, yes. But it wasn't that everyone defaulted on their mortgages, therefore the economy collapsed. It was enough people had started defaulting at a rapid enough pace that that managers in New York City and in the finance sector started to read the room and see what was happening and be like, oh crap, this is not going to go well. Like they started to see the dominoes falling. And so that's what this is getting at, is it's people waking up and realizing this is going on. And this is, I think, why you're starting to see sell-offs on Wall Street right now, and people who are responding because they see what's happening. And now this dives into mortgages, because this is related to this. So the U.S. Residential mortgage market is approximately $13 trillion. Mortgage underwriting is built on the fundamental assumption that the borrower will remain employed at roughly their current income level for the duration of the loan for 30 years in the case of most mortgages. The white-collar employment crisis has threatened this assumption with a sustained shift in income expectations. We now have to ask a question that seemed absurd just 3 years ago. Are prime mortgages good? So basically, the people who have so we've rebuilt the entire mortgage sector, right, after 2008. Changed how subprime borrowers get access to loans. We're not giving people who can't afford to maintain a mortgage access to the credit they would need to buy massive homes that they can't afford. So the people who are really buying homes right now, they're high quality, they're prime. They're people with great FICO scores. They put down a down payment. They have good credit histories, stable employment. They aren't missing payments. They're not in default. They're not bankrupt. These are the people who you want to issue loans to because they reduce risk. And it says here, these are the people that are the bedrock of credit quality. In 2028, the loans were good. So in 2008, the loans were bad. In 2028, the loans were good. The world just changed after the loans were written. People borrowed against a future that they can no longer afford to believe in. So this is attesting to the fact that this is happening at the institutional level, but it's also happening at the consumer level, right? So you have asset managers and private equity firms that have bet on companies and SaaS and different structuring of financial assets based on the premise of annual recurring revenue and subscription models, and that there would be perpetual growth. So that's one example. And then the other example is with mortgages. You have banks that have issued loans to everyday people like you and I based on the premise that we're going to get, maintain jobs. Same as student loans. Student loans are being issued under the promise and then the expectation that you're going to get a job after college. Well, that didn't turn out to work, did it? Right? So anyone who's in college right now, I think you have to ask yourself, like, what are you doing? Because there's clearly no jobs. But basically, the entirety of the consumer, institutional and consumer credit markets are predicated on assumptions that are going to go out the window because of AI. So this is why AI is going to be so disruptive. So it says in 2027, we flagged early signs of invisible stress, HELOC draws, 401k withdrawals, which by the way, I think like half of Americans withdrew from their 401k last year. So this is already happening. Credit card debt spike, that is already happening. The Federal Reserve just released a new report about that. While mortgage payments remain current, As jobs were lost, hiring was frozen, and bonuses cut, these prime households saw their debt to income ratios their debt to ratios incomes double. So I just want to plug real quick. I'll have to note for myself. I want to plug this. This is something I cover on a weekly basis. I look at these different things. So I write about the 401k withdrawals of credit card debt, and I write a weekly newsletter. So if you're interested in seeing these micro signals that are impacting the macro picture that this essay talks about, I'll leave a link below, but definitely go and subscribe. I talk about job losses and concentration. This last week I talked about the retail recession, and how that is impacting workers. So for example, Wendy's announced they were closing a lot of restaurants, Red Lobster as well, and how that's going to impact jobs, right? So again, this feeds into this whole narrative that this piece is talking about. But you have displaced white collar workers who are going to have to trade down. They're going to have to work in retail and hospitality and gig work. Well, gig work is going away. There's different types of competition there. But then you also simultaneously have retail, a lot of it private equity owned, that they're closing shop. They're cutting employment opportunities as well. So basically the foundation or the safety net that white collar workers think they have access to, they don't. So I write that on a weekly basis. If you want to subscribe, definitely recommend doing so, because I think it gives you a good insight into how the day-to-day is transpiring to create this outcome that this essay talks about. It says that these prime borrowers could still make mortgage payments, but only by stopping all discretionary spending, draining savings, and deferring any home maintenance or improvement. I would say also maxing out credit cards as well. They were technically current on their mortgages, but just one more shock away from distress, and the trajectory of AI capabilities suggested that shock is coming. So places that are exposed could have greater exposure. So delinquencies, it talks about how concerns are building. They're not in a full-blown mortgage crisis, so delinquencies have risen but remain well above 2008 levels. It's the trajectory that's the real threat here, and it talks about why. I think this is a really good infographic that talks about why that's the case. So it says labor displacement, mortgage concerns, private equity turmoil, each reinforce the other, and the traditional policy toolkit, rate cuts, quantitative easing, can address the financial engine, but cannot address the real economy engine. So quantitative easing, rate cuts, that's all tools of monetary policy that can't fix the structure of the economy itself. Because the real economy engine is not driven by tight financial conditions. It's driven by AI making human intelligence less scarce and less valuable. So the fact that intelligence is becoming abundant, humans no longer have the competitive advantage on cognitive labor. That's what's really transforming. So it's a transformation of the economy itself. It says what's clear is that the income assumptions underlying $13 trillion in residential mortgages are structurally impaired. What it isn't is whether policy can intervene before the mortgage market fully processes what this means. And so now this last section of this essay is talking about what needs to be done, right? So it's clear that there's a negative feedback loop in the real economy. So AI capabilities improve, payroll shrinks, spending softens, margins tighten, companies buy more capability improves. That in turn, financial income impairment hits mortgages, bank losses tighten credit, the wealth effect cracked, and the feedback loop sped up. And both of these have been exacerbated by an inefficient policy response from a government that seems quite frankly confused. So you have the real economy or the Main Street economy, the financial system that is built on top of that economy. And then you have policy, like government policy that is supposed to respond to manage the economy. But it's incapable of doing so. And I've talked about this in other videos. No one's talking about this. The only person who's talking about it is Bernie Sanders and Andrew Yang, but he's not even in politics. No one in Washington is talking about this. No one is preparing for it. Everyone is still distracted by all sorts of the issues du jour. No one is talking about the response, what we need to do to anticipate this. And if this is correct, we have less than 2 years, right, until this plays out. So it says the government's revenue base is essentially a tax on human time. People work, firms pay them, the government takes a cut. Individual income and payroll taxes are the spine of receipts in normal years. And yes, we can have all sorts of conversations about changing the tax structure, but at the end of the day, it hasn't changed yet. So as of right now, And moving forward, this is how the government generates revenue, by taxing income. Payroll receipts are falling because fewer people are employed at prior compensation levels. Income tax receipts are falling because the incomes being earned are structurally lower. Productivity is surging, but the gains are flowing to capital and compute, not labor. And we don't tax capital the same way that we tax employment and income here in the United States. So again, we can have conversations about that. We can talk about it, but that doesn't translate to policy change. Unless something is moving right now in Congress, it's probably not going to be implemented in time. And given that this is a major midterm election year, probably nothing is going to happen. Let's just be honest about it. So it says the output is still there. This is like the ghost GDP that they were talking about, but it's no longer routing through households on the way back to firms, which means it's no longer routing through the IRS either. And that's because jobs are the linchpin for all of this to work. Jobs are the linchpin for the flow of productivity gains from employers to the Main Street economy, to workers. Jobs make it possible for people to transmit income to one another and transmit wealth. Jobs make it possible for the government to collect revenue, right? So you eliminate jobs, you eliminate the entire infrastructure that our economy and our government is predicated on. And so it says the people who need government support today were not hit by a pandemic they'll recover from. They were replaced by technology that continues to improve. The government needs to transfer more money to households at precisely the moment it is collecting less money from them in taxes. And this is why the social and the cultural crises, the culture war you're seeing play out right now, actually matters within this context, because our social fabric is fraying. We're politically polarized more so than ever before, and people are going to be less and less inclined to help one another, right? And so I've talked about this with regard to women. I think women are going to be on the front lines of job losses and displacement because of AI, because of all of this. A lot of these jobs mentioned here are female-coded jobs, right? So women are going to be the biggest losers to AI-related job displacement in the white-collar economy. They're not going to be the first ones to sign up to drive for Uber. Like, let's be honest here, they're not going to reskill to become plumbers. They're not going to, they're not going to voluntarily return to the home and start raising children. A lot of these, especially millennial girl boss feminist types, they're going to look to Uncle Sam to provide for them. They're going to think something is owed to them. So maybe it's access to the social safety net as it currently exists, or demanding either the wealthy or blue collar workers to pay more than their fair share to subsidize them. They're going to effectively expect a subsidy to maintain their current quality of life. They're not going to change. And so this is going to create far more tension than what we're seeing now. And this matters because if you've been paying attention, these feminists are becoming hyper politically radicalized to the point that they're starting to engage in acts of violence. So this is going to potentially blow up. I think this is a powder keg that could really explode, and people should pay attention to. It's not just, feminists are evil and they have unrealistic expectations on men, and they're awful and all this kind of stuff. Like, this is going to translate into political action because of the economic pressure that's going to be put onto them because of AI displacement. So this all this relates. I think it's a pretty big deal. So it talks about here, potential solutions, or it refers to UBI as one, but another would be what they're referring to as the Shared AI Prosperity Act, which would establish a public claim on the returns of the intelligence infrastructure itself, something between a sovereign wealth fund and a royalty on AI-generated output, with dividends funding household transfers. So maybe that's possible, but as folks on the right have been, I think, aptly criticizing, wherever redistribution happens with the government at the helm, it's going to be Marxist in nature, and I don't know that we want to go that route, and I think it's going to reduce everyone to the lowest common denominator. I don't think it's going to leave room for growth or flourishing. And so while politicians bicker, the social fabric is fraying faster than the legislative process can move. It's hard to imagine the public hating anyone more than bankers in the fallout of the great financial crisis, or global financial crisis, but the AI labs are making a run at it. And from that perspective of the masses, for good reason, their founders and early investors have accumulated wealth at a pace that makes the Gilded Age look tame. And just look at, folks like Mark Zuckerberg. I think that a lot of people would agree with this. So AI capability is evolving faster than institutions can adapt. The policy response is moving at the pace of ideology, not reality. If the government doesn't agree on what the problem is soon, the feedback loop will rewrite the next chapter for them. And this could be why you got billionaires building bunkers, because I think they see this is coming. They know that that law and order is breaking down. Our social fabric is breaking down. And desperate times are going to lead people to do desperate things. So I think that could be why they're moving in that direction. Okay, so this closes out by talking about what is actually happening. So the financial system, optimized over decades for a world of scarce human minds, is repricing. That repricing is painful, disorderly, and far from complete. But repricing is not the same as collapse. The economy can find a new equilibrium. Getting there is one of the few tasks left that only humans can do. We need to do it correctly. This is the first time in history that the most productive asset in the economy has produced fewer, not more jobs. Nobody's framework fits because none were designed for a world where the scarce input became abundant. So we have to make new frameworks. Whether we build them in time is the only question that matters. So this is happening, change is happening, whatever we think, like the mental models and the frameworks that are supposed to help guide us into navigating this are no longer relevant. They're out the window. Whatever we think is going to happen probably won't happen in the way we expect it to. So we need to start planning. And so I think at an institutional level, things aren't happening fast enough, right? You have incentives, companies like OpenAI and Anthropic and all those tech companies, they have their own incentives that are going to lead them to go in one direction. You have investors that have their own incentives. You have financial firms and those who manage capital flows who have their own incentives, and their incentives are different from your incentives, my incentives, our desires, the government process, and institutions that are supposed to be in place to help mediate all of our different competing interests. And so I think this is why this is going to be incredibly difficult, because we don't have alignment on, we don't agree. We don't agree on the fundamental problem. At least, when the atomic bomb came out and during the Cold War, I think everyone was kind of on the same page. USSR bad, America must beat USSR, not let nuclear war happen, right? I think everyone kind of agreed on that, for more or less. Now we're kind of dealing with a relatively similar kind of transformation, technologically speaking, with debilitating consequences, but we're not on the same page anymore, right? And the institutions we need to mediate our differences are incapable of doing so. So I don't think that the institutions that we need to build the new equilibrium are going to be able to do so. So I think it's on every one of us as individuals to do that for ourselves, to read the room, figure out what's happening, and go from there. And I think for some people, they're going to thrive and they're going to do really well. Others, not so much. But I think now is the time to really start thinking, like, what is my purpose? What is my role? What am I doing? Is the trajectory I'm moving in, does it make sense anymore? Should I pivot? Should I try something new? Should I take a step back? I think return to community is going to be big. I think people are going to have to get out of cities and they're going to have to rebuild, go places where things are affordable, where human skills are still needed and desired, and find purpose and meaning there. So I think that's going to be one outlet. And I think communities that are tight knit and look out for each other, they're going to provide the protective and security mechanism that they're going to need when large scale institutions fail. So I, don't want to be in Zoran Mamdani's in New York City in the coming years when all this really starts to continue playing out. So I think you're going to see a return to small town America, a rebuilding of Main Street, I hope, and in communities that look out for one another. I think that's going to be essential now more than ever before, because we can't predict what this new world is going to look like, but we can try to anticipate it as best we can and mitigate risks, right? And so I think that's what each and every one of us ought to look to do. But yeah, this, like I said, this was a long piece, but it went super viral. It impacted the Dow Jones. It impacted the stock market. Folks are reading this and they're like, yep, this makes sense. This could very much happen. They understand how the daisy chain of everything is connected and the implications. And hopefully this helps you make aware, see how everything is interconnected too. This isn't just, a handful of software engineers losing jobs. This isn't about AI being able to write code better than you, or, write copy or whatever. This is about how our economy is structured and the system in which we currently live within, and how it's incapable to handle the AI revolution that's underway. And so we're going to go and undergo systemic change. That's going to be massively disruptive. The question is, are you preparing for it? And if so, what are you doing now? So that's what I have for you today. Like I said, I write about this stuff all the time over at Tomorrow Today on Substack, and I write a weekly newsletter as well. Subscribe to those if you're interested in this stuff and you want to stay ahead of the curve, because I think this is really important. Otherwise, share your thoughts below. I appreciate you for listening. I know this was a long-winded one today, but I appreciate it. Definitely like, subscribe, share with anyone you know, and I'll see you in the next video.